Hello viewers, welcome to my channel. I'm Hashim. Now I'm going to start the subject financial management. This subject is very important for students of BBA, MBA, MCom, even in BCom also it is included. And apart from that, this subject is very important for all professional courses like CA, CMA, CS, etc. Finance means the funds. Without funds, no business can function. Finance is required for doing all other activities of the business like production, purchasing, and staffing. Everything, every activity of the business depends on finance. The funds have to be properly controlled, managed, planned, all these things. Now, in this unit number 1, the finance function, I'm going to explain the different topics. So before going to learn the techniques of financial management, first of all, we must know the basic concepts. What is this financial management? What is the nature and scope of financial management? Then evolution of finance function and new role of finance in the contemporary scenario. Then what are the goals of finance function like maximization goal or satisfying goal? Apart from that, wealth maximization, profit maximization, welfare. And then the agency, relationship and cost. Then risk return trade-off and the time value of money, that is present value and future value. All these things I am going to explain in this unit number 1. Without understanding the concepts, you should not go to learn the techniques of financial management. So these are the basic things which every student must know. And in examination also they may ask you the theory regarding this financial management. So watch the video till the end to get the complete command of this subject. Very interesting subject. And this financial management is gaining importance day by day because of technological innovation due to industrialization, privatization and globalization. The need of funds are increasing day by day. So it becomes a very important subject for planning, controlling, managing the funds. So before explaining further, take the screenshot of the points which I have written on the board. Then I'll explain all the points in detail. Now, first of all, we are going to study in this video regarding the meaning of the term finance function or financial management. Then we will learn about the nature and scope. Financial management, it is that activity of the business which is concerned with planning, controlling, monitoring, administering the funds required, the funds of the business. So this finance has to be controlled properly in order to meet the liquidity of the business and profitability of the business. Different definitions have been given by different authors regarding the meaning of the term financial management. But all the definitions will conclude at one point that it is the activity which is concerned with planning, controlling, coordinating. Here, financial management is concerned with planning and controlling of the firm's financial resources. Without finance, no business can function. Finance is required. So before raising the funds, we have to plan from where we have to procure the funds. Now, due to globalization, funds can be procured from throughout the world. From any country, the funds can be procured, whether internally or internationally. Similarly, funds can be raised either by debt or by capital. All these plan we have to make. Apart from planning, controlling. That means whatever funds are there, that should be properly utilized in the business. The funds should not remain idle. There is a saying in finance. Keeping a rupee idle will incur cost. So we should not keep the idle funds. Always the funds should be invested. The funds should generate an income. So here it was a branch of economics till 1890. This finance actually was not a separate subject. It was a branch of economics till 1890. Later on, it has been separated and made a specialized subject. Lot of literature, lot of theory has been written on financial management and the techniques of financial management. Since last 50 years, we can see the development of this subject. It has become a very important subject throughout the world because the funds have to be properly managed. There are many instances where the companies have collapsed due to bad financial management. They have the lot of production capacity, demand, everything is there, but due to not proper management of funds, the business had collapsed. So financial management can be broadly defined as the activity which is concerned with planning, raising, controlling and administering of funds in the business. This is the best definition which gives the complete meaning of this financial management. So finance function may be defined as the procurement of funds and effective utilization of funds. See here, first of all, funds have to be procured. It's not an easy job to raise the funds because we have different sources through which the funds can be raised. The funds can be raised either by taking a loan from bank or by issuing debentures or by raising by capital. Different sources are there. The business has to evaluate which source is suitable, right? Similarly, utilization. Once the funds are raised, properly utilized, the funds should not be misused. That means before investing the money, we have to evaluate from different angles whether it is prudent, better to invest the money in this project or not. So, raising of funds and effective utilization of funds. These are the basic functions of financial management. So from various definitions given by different authors regarding the term financial management, we can conclude that the term business finance can be concluded involves raising of funds and their effective utilization, keeping in view the overall objective of the business. From where to procure the funds, how to utilize the funds, keeping in view the main objective of the business, that is the main function, finance function. Now the management makes use of various techniques. Remember, there are different techniques available for raising the funds, for utilizing the funds, various techniques. In the coming units, you can see all the techniques which are used by finance manager in order to take financial decisions. So various techniques for administering the financial affairs of the firm in the most effective and efficient manner. So many sophisticated techniques are also there regarding how to take the finance function. So according to traditional approach, there are two approaches: traditional approach, modern approach. Traditional approach is concerned with finance, is concerned with the raising of money. That means the scope of finance function was limited according to the traditional approach. But now, due to development, due to complexity of the business, then the scope of financial management has also increased. Now it is not concerned only with procurement of funds. It is concerned with the utilization of funds also in a better manner. The funds should neither be less nor it should be more. There should neither be undercapitalized nor it should be overcapitalized. Adequate capital should be there so that the liquidity and the profitability is balanced. Now, finance, production and sales are the three important aspects of any enterprise. Actually, there are different departments, different aspects, but most of the businesses will have three departments. The three departments are finance department, production department and sales department. So we can make a triangle of these three aspects. In that triangle, the base is finance. Without having finance, we cannot produce the goods. When we can't produce the goods, we cannot be able to sell the goods. So every activity of the business depends on finance. Simple example, the production manager says in order to increase the production, we want new technology in production. But new technology involves funds. Similarly, the sales manager says in order to promote the sales, we need the funds. Without having funds, we cannot make any promotional activity. So we can say production and production and sales depends completely on finance. Colin Brook, one author, he has given the importance of financial management. He says bad production management and bad sales management have slain their hundreds, but faulty finance have its thousands. That means if a mistake is being done in production or sales department, the losses may be in hundreds. But if a faulty or wrong decision is taken in finance department, the losses may go in thousands. So this Colin Brook has given more importance to finance, that we should not commit any mistake in finance because the losses may run in thousands. Whereas mistakes made in production or sales, the losses may be 100 comparatively. The financial manager plays a crucial role in utilizing the resources in a most profitable manner. Remember, funds are scarce. It has to be utilized very carefully. So it is the responsibility of the finance manager to effectively and efficiently utilize this resource. Which resource? Financial resource. Now, for effective utilization of resources, he has to take the following decisions. The finance manager has to take a number of decisions called financial decisions. The important financial decisions are, first one, investment decision. So before investing the funds in any capital project, like purchasing the machine or launching a new product or making advertisement, for any investment project, the business has to evaluate what are the consequences of investing the funds. So before making the investment, we have to evaluate from different angles. Example, a machine has to be purchased. So before purchasing the machine, the company, the business has to evaluate what are the consequences, what are the cash inflows and cash outflow of purchasing this machine. So different techniques, capital budgeting techniques are there. By applying those techniques, the finance manager will decide whether to invest or not to invest. Similarly, financing decision. Second most important decision is financing. Financing means from where to procure the funds. Just now I told you there are many sources through which funds can be procured. Now business has to evaluate. We cannot say that always capital is good. We cannot say always debt is good. There should be a combination. Every business will make a combination of debt and equity. Proper combination should be there. No business will depend only on capital. No business can depend only on debt. A proper combination. That is called financing decisions. A number of techniques are there for taking financing decisions, like cost of capital, capital structure, leverage. These are all the techniques available for taking financing decisions. Next comes dividend decision. Dividend is a part of profit of the company which is distributed among the shareholders. The owners are the shareholders. They have invested the money in the company in order to get the dividend. Business has to take a decision. The company has to take a decision on how much dividend should be paid. So there is a decision to be taken regarding how much dividend to be paid and how much to be retained. No business can pay all the profit in the form of dividend. Just like a normal person will not spend all his income. A part of the income a person will save for future, because future is uncertain. We don't know what will happen in future. So to be financially sound, we should keep some saving. Similarly, a company has also to keep some profit in the form of saving. That saving is called reserves. So some part of profit should be kept in reserve. The other part should be declared in the form of dividend. Now, finance manager has to help the management regarding how much dividend to be paid and how much to be retained. Again, we have different techniques. Dividend policies are there. In one of the unit, I will explain you regarding how to take the decision regarding dividend. Next comes working capital. Working capital means the money required for day-to-day expenses. All the funds should not be invested in fixed assets. Some funds should be kept for meeting day-to-day expenses. Just like every month salary has to be paid, rent has to be paid, electricity bill has to be paid, telephone bill has to be paid. A number of miscellaneous expenditure is there every now and then the business will incur. The business must have sufficient funds to meet all the current obligations on time. That is called working capital distribution. Otherwise, what will happen? If the business cannot be able to meet all the current obligations, the liquidity problem will arise. That means if there is a cash shortage, we cannot be able to pay the salaries on time. We cannot be able to pay the rent on time, electricity bill on time. That means the credit worthiness of the business will come down. The credit rating of the business will come down. No supplier will come forward to supply the goods. No bank will come forward to give the loan. That is the reason why the business has to maintain working capital. Sufficient money to meet all the current obligations, that is working capital. In that working capital, we'll study about cash management, receivables management, inventory management, etc. So, in this video, I have explained you only the basic things regarding financial management. In the next video, I'll explain you about the scope and evolution. So if you want the perfect knowledge, watch all the videos from beginning till end. Don't skip in between.